Hi, everybody. Wendy Byford here. We are live with an interview with Mel Kaye. Now, I did put this up on Bizengaged for Entrepreneurs with LLCs, and it is going to the YouTube channel. If you can't stay on for the entire broadcast, then just make sure that you go back to the YouTube channel and pick up what you missed. Meanwhile, for the next half hour, we're going to be talking about succession planning. Now, I met Mel in a networking group, of course, that's where I meet everybody. And what he was doing absolutely fascinated me. Mel is a dedicated life insurance consultant who specializes in succession planning, infinite banking, tax-free retirement, and high-yield annuities. Wow, that's a mouthful, right? He is an independent agent and he represents over 30 top-rated life insurance providers. That gives him a really broad range of products that he can offer, and he uses them really interestingly. That's why I wanted him to have a chance to come and talk to you guys, because what he does is so important for small business owners, including solopreneurs. None of us goes into business so that at the end we can just shut it down and walk away, right? We'd love to leave a legacy for our families, or we might want to have partners and we want them to be able to continue when we're either gone or we retire or whatever. And so succession planning is really an important thing for us to consider. So I'm going to ask Mel to introduce himself, and then we're going to start the conversation.
Yes. Hi, everybody. My name is Mel Kaye, and like Wendy said, I am a professional life insurance consultant, and I specialize in, like she indicated, succession planning and infinite banking, tax-free retirement, high-yield annuities, and really focusing on the small to medium-sized businesses where there's multiple owners. And that's, well, my background is in corporate America, dealing with businesses. Got into life insurance, like dealing with individuals, but I prefer dealing with businesses. I'm used to them, I know them, and I think I hopefully know what's important to them.
Great. So, Mel, let's start out by explaining to everybody what succession planning really is. I know that everybody's got their idea of what it might look like, but in the world that you deal with insurance products and annuities and all those sorts of things, what is succession planning actually?
Well, succession planning is broadly, what happens to the business when one of the owners leaves, either purposely leaves or not on purpose, they die.
Right.
What happens? Okay, that is, and you need to plan for that. Businesses need to plan for that particular day, because in many businesses they fail because they fail to plan what happens when one of the owners dies. Okay.
So, so this has got to be a really huge issue, particularly if people have partners.
Yes.
Right? Nobody goes into business with a partner expecting that one day the partner's just not going to show up, right?
That's correct.
And
correct.
Although we often try to protect ourselves against things like midlife crisis. Your partner decides to buy a red Ferrari and take his secretary down to wipe his salaries or something. There are other reasons why you might lose a partner.
Absolutely. And I think a key question that you need to ask is what happens to your company, okay, if one of the owners unexpectedly dies? Okay. I mean, he's gonna obviously he's gonna have a will, hopefully, and he's gonna leave everything to his spouse, to his kids, to somebody who's all of a sudden now going to have a piece of the business.
Mm-hmm.
Okay. Right. Now, what companies should do is to plan for that eventuality. Okay? And the best way to plan, I mean, you can put money aside, but that's taking money out of the business. You can take a loan out at the time, when one of them dies. or you can sell off some of the assets, which can lead to total disruption of the business. Okay.
Right.
So again, kind of backing up a little bit, if one of the partners dies, there's going to be the heirs who's going to, like I said before, have a piece of the business. Okay. Now, the best way to deal with this is really twofold. First is to get in place a buy-sell agreement. That is an agreement that dictates what happens if a partner leaves, either purposely or unexpectedly. Okay. Now, these buy-sell agreements, when a partner dies, will indicate what happens to his share of the business. Okay, and in those buy-sell agreements, you'll have, the value or potential value of the business. Okay, now partner dies, that money's got to come from somewhere. Like I said, you can either put money aside, you can sell off some of the assets, you can take out a loan, or you can buy life insurance. Okay? That is the least expensive way of funding the buy-sell agreement. So what happens is the business takes out a policy on each of the owners.
Okay. And that is a business expense?
No,
No?
the
Okay.
premiums are not tax deductible because the eventuality
Mm-hmm.
of the money coming in is not tax deductible. So if you take out $1 million policy, $1 million comes in, that's free and clear, $1 million.
Mm-hmm.
Okay, so the money going into that is not a business expense.
Okay,
And
that's
then,
important.
I mean, if you've got a very, very, very creative tax, preparer, I'm not saying anything beyond that.
Okay.
Okay,
So
okay.
point is, talk to your CPA.
Talk to your
Um,
CPA. Absolutely,
okay, so you
absolutely.
take out key man insurance or something like that on each of the
Right.
partners.
It's all the same thing. Yeah, buy-sell agreement, key man insurance, it's really the same thing. Okay.
Okay.
Now, there are multiple types of policies. There's a term policy, which expires after so many years. There's a whole life. There's an IUL, Index Universal Life, which is the one that I use more than
Okay.
any other because it's a designable policy. Okay. Now, one thing you may be asking yourself, okay, if the partners don't die and they all live nice, ripe old age, 65, they decide to retire, is what happens to all the money we put into the policy, it's gone, right?
Mhm.
No, it's not gone. This IUL, you can be designed in such a way that the money that you put into the policy at the end of the policy, okay, nobody dies, money's there, it can be taken out by each of the individual partners as tax-free retirement income.
Now that's interesting. Um, so let's put this in perspective. If your entity solution set up your LLC,
Mm-hmm.
then in the operating agreement, there is an elementary buy-sell agreement.
Mm-hmm.
And that basically says that if you pass away, then your heirs have an economic interest in the company. So they can't come in and start to tell you how to run it. Okay. So that's good. However, the heirs may decide that they want to sell their part of the company.
Right.
And that's where what Mel is talking about comes in, because you don't want to have to take out a loan or sell off assets in order to pay the heirs for their share in the company. You want to have some other way of
Exactly.
being able to fund that.
Exactly.
So what Mel is proposing is that you basically take out insurance on each of the partners that will either fund the buyout to the heirs, and then they get the money and they go away happy. Unless, of course, they want to stay as just economic interest partners, and that's fine.
One second. That's all dictated in the buy-sell agreement as to
Right.
exactly what happens.
Right. And that's in if we set up your LLC, that's actually in the operating agreement. So, and so that would be, if they want to stay economic partners, then they can do that. Or they can ask to be bought out, in which case your insurance is going to fund that. Or if the person would like to leave on retirement, this is the part that I just love, guys. If the person wants to retire at some point in time, and not bankrupt the company by taking their half and running away, then they can fund that through the insurance. And I think that that one part is really crucial, right? Because let's face it, when you start a business, nobody's starting it so that you lose everything, right? Or you collapse the business. You're expecting that the two of you are going to run this business until both of you want to retire or sell the business or whatever. But that's not always what happens. So here's a life event that happens more often than we think. You're in a business with a partner. You're running along. Everything is going fine. The partner doesn't get ill, but their spouse does, their parents do. Something is causing them to have to either pull money out of the business, right? Sell off their interest or part of their interest, or they have to leave the business to look after their spouse or their parents or whoever. Those are really critical life events that are happening more and more because people are living longer. My dad's going to be 100. Think about it. He's going to be 100 next year, right?
Wow.
And it wouldn't be unusual for me to have to say, okay, I have to either sell off my business or somehow leave it in an orderly fashion in order to go look after my dad. Right? So figuring out what to do beforehand, right, is really important. So Mel, let's talk to those things. Let's talk to life events.
Yes, absolutely. You see, my name, I call it Succession Plan Plus. Okay. The succession plan is, if a person dies, what happens? The plus is everybody lives, and there's a lot of pluses within this particular policy. Okay. Number one, you can use it for infinite banking. That's a term that some people understand, some don't. Infinite banking means that you can borrow from the life insurance plan without decreasing its cash value. So as the plan grows over the years, you've got a certain amount that grows in cash value, and that grows, it grows quite fast, actually. Okay, almost in a geometric, progressive sort of way. You may need that money to expand the business, or you may need that money to take care of a personal issue. Okay, so you can borrow against it. Now, say that the interest on the plan is between 8 and 12%, and that's what historically it's been, between 8 and 12% a year. Okay, you can borrow at 5%, up to 5%, no more than 5%. So you're actually borrowing money while still making money on the policy.
Okay.
Then it's up to the individual how you pay it back and when you pay it back, even if you pay it back, because the insurance company is guaranteed that they'll get their money because it comes off of the death benefit if the person dies before they pay it back.
Okay, understand.
That's number one on the infinite banking concept.
Right.
Number two, what a lot of companies are doing is they're overfunding this up front. So if you've got money sitting in a savings account, let's say, for emergency, say you got 100, 200,000, whatever it is, you can put that into the policy.
Okay.
That does a number of things. One, you earn the interest on it, substantial interest. You can borrow against it. And the money that's in the policy is protected against judgments, liens against the company, creditor demands. That's all protected.
Right.
So you've got a protection there.
Okay.
And you can borrow from it, like I said. Okay.
So if the company is buying the policy, then presumably you need to have a resolution that allows you to borrow against it for issues other than expanding the business, right?
Yes,
So
yes, exactly.
create
Yeah,
a resolution to allow
yes.
a personal loan,
Mhm.
and then you can take that money and do what you need to do with it. The company is still funding it, right? But also, it sounds like when you set these policies up, let's say that the business has an emergency fund,
Mhm.
okay, and maybe they've got 50,000 just sitting in the bank for emergencies,
Mhm.
right? They've had a bad month or whatever, okay. Um, then they can fund that that much into a policy
Mhm.
to get it started, and then borrow from it if they have the emergency. Is that right?
That's correct.
Okay, so it's not just sitting in the bank
No, no.
waiting; it's actually making money.
Is actually making could be substantial money,
Mhm.
and the way the interest works is it's an index funds indexed against some funds that the bank has. It's gone as high as 23%
Okay.
in a particular year.
Okay.
And in case of a bear market
Mhm.
just turns to absolute crap.
Mhm.
It stops at a plus 0.25%. You can never lose money on it.
Okay. So, so Mel, many of the people that my husband and I deal with in our business, in our
Hmm.
LLC business,
Hmm.
these are solopreneurs, small business owners,
Hmm.
just starting out
Hmm.
with the business. Now, they may have been in corporate America for 30 years, like we were before they
Hmm.
start the business, so they may not be, youngsters. Um, but they're just starting the business out. So, at what point in time would you suggest that they get started with these type of policies?
Immediately.
Okay,
The reason
and
I say that is it's a life insurance policy,
mhm,
and the premium is going to be based on a number of factors: the
mhm.
age of the individual and the overall health of the individual.
Okay,
Okay, so obviously, if you're in your mid 20s and healthy, you're going to get the best bang for the buck on this thing. But
right.
if you're in your mid 50s, let's
Mhm.
say, and not so healthy, the premium is going to be substantially more
Okay,
for the same uh, death payout, death benefit.
right. So the earlier that you start, the better. Let's take a look at many of our clients are in real estate investing, for example.
Okay,
So the business
perfect.
itself,
Perfect.
they may have for 5 years, and then they've got another business. So
Hmm.
they maybe buy a piece of land, they flip two or three pieces of land in an LLC, then they
Yes,
shut that down, they start another one. So
yes.
how does this work when it's not a single business entity that you're dealing with?
Well, if you're talking about an individual, I mean, he buys the policy for
Mhm.
himself. Okay, or it
Okay.
can buy it under the business name. It really makes no difference as far as utilizing it goes. Okay, so
Mhm.
he's got let's say he wants a $5 million policy. All right,
Mhm.
and he's got about $250,000 sitting in the bank right now, waiting for the next investment. Okay,
Mhm.
he puts that into the policy, plus he pays the premium.
Mhm.
Okay, and it's a designable policy, so it can be designed in a way that the client wants it designed. And it can be based also on how much retirement income the client wants. So you can
Okay.
work backwards on it, forwards on it, middle out. I mean, this is what I do.
Mhm.
This is what I love doing. So,
Okay.
so following year, he finds a great piece of property.
Right.
All right. So he borrows against his policy, buys
Okay.
that property,
Uh-huh.
flips it, returns that money, pays off the loan,
Mhm.
does it again. So as he's borrowing at anywhere from it's a variable rate, anywhere up to 5%, he's
Mhm.
earning up to 23% on the same money. That's the concept of infinite banking.
Right. But let's say if he's got $250,000 sitting in a bank to buy a property and the
Mhm.
property is going to be 200,000, he can't borrow that amount back again out of the policy, correct?
Yeah, absolutely.
So
It's
that
cash.
has to be 5% of some enormous policy.
It's cash value.
Yeah. Okay.
Okay, so a part of the premium
Mm-hmm.
goes towards the death benefit,
Mm-hmm.
and a part of that premium goes towards cash value.
Okay.
The full 250 would go into cash value.
Okay. Got it.
Okay, so then that cash value is going to be growing substantially, and
Mm-hmm.
you're borrowing against the cash value,
Mm-hmm.
collateralized by the death benefit.
Okay. Got it. All right.
Okay, now, something we've talked about, but not in detail,
Mm-hmm.
is that you would, in the design of the policy,
Mm-hmm.
determine, okay, I'm going to need, at 65, I'm going to need at least 25 years of $250,000 a month, a year coming in as
All right.
retirement income.
Mm-hmm.
Okay, and again, this is non-taxable.
Mm-hmm.
Okay, because in reality, again, you're borrowing against a huge cash value with no intention of paying it back, and that's all worked into the algorithm. Okay, so that's what you want. Then we figure out at the beginning what policy limits is it going to take to get you there.
Right. Okay.
And then in the middle, you can still use that to borrow, to buy income producing assets. That's the ideal,
Right.
is to use it for income producing assets.
Okay. So if people want to either expand their business, or if they're
Yes,
flipping properties or
yes,
land or any of that sort of thing,
right.
then this is a really good investment for them.
Oh, it's a fantastic investment for them.
Okay. So this goes back to your infinite banking.
Right. Infinite banking is part and parcel of the succession plan plus, and that's just a term that
Mhm.
I use
Okay.
for my program. Okay. Now I've got, I guess, like you said, over 30 carriers, and
Mhm.
probably about half a dozen of them have got really good IUL policies.
Mhm.
Okay. So,
Okay.
so I've got my go-tos, so to speak, and it's really based on the health of the individual.
Right.
Okay.
Okay.
So if it's really healthy and young, I know where to go. And if they're not
Yeah.
so healthy, I know where to go to get it.
Right.
And, it's that's what I
Okay.
do.
Perfect. Okay. So that's what you do, Mel. How do people get hold of you?
Well, I've got a website which really indicates, all the various programs that I have and a number of domain names. And the one for this is successionplanplus.com.
Okay, so if they go to successionplanplus.com, then there should be a way for them to get hold of you to talk about this further.
Leave a comment, say that you want an evaluation, free evaluation. We'll see what the property, what your business is worth, how many partners are there, the age and the health of each one, what's the cost of the premiums going to be. No fees for any of that stuff.
Okay,
Then
perfect.
we'll put it together, and yeah, you'll tell me what you want to do.
Fantastic. Okay, so everybody, whether you are a solopreneur, small business owner, just getting started out, this gives you some options. First of all, going into any business, decide what your end game is going to be. I know that can be a little scary if you're just starting out doing copywriting or virtual assistant or anything that you've never had before. But when you first start your business, try and figure out what your end game is going to be. Do you want to sell the business? Do you want to pass it on to your family members? If you have partners, do you want to leave your part of the business to your partner? What is it that you really want to do? And then when you go into a discussion with Mel to talk about, how you kind of bulletproof your succession plan, he'll be able to advise you better on what's going to get you where you want to go.
Right.
So just bear in mind that when we do your LLC, there is an elementary buy-sell in there as well. You're going to want to take that to Mel so he can actually see what the operating agreement says, because that's going to
Mhm.
dictate a lot of what you currently have. And just remember, your operating agreement is not cast in stone. It can be changed. If you decide that you would like to do something different, then the operating agreement can be amended to what it is that you really would like to have farther down the line. So, Mel, it has been an absolute joy. People can get hold of you at successionplanplus.com. Put in the comment that they would like to get an evaluation, and you'll be able
Mhm.
to talk to them about what they have and where they're going and what they're going to need. Any
Absolutely.
final words that you would like to say?
Um, the policy itself is flexible as you go forward. So you start off with the company being the owner and each of the partners being the insured. Okay. At any point in time, that can revert. Company can release the ownership of it and give it to the actual individual. So say after 10 years, they leave the company.
Mhm.
They take the policy with them. The policy stays with the insured.
Okay, good thing to know.
Okay.
All
So
right. Fantastic. Well, thank you very much, everybody, for watching. And if you didn't have a chance to get all of the discussion, just be aware it is on the YouTube channel. You'll be able to pick up the discussion there and find out what we've been talking about for the last 26 minutes or so. And also, you can drop comments in the YouTube channel, and we'll make sure that they get back to Mel. Thanks so much for being my guest, Mel. Really appreciate it. Hope you have an absolutely fantastic day, and thank you everybody for watching.
thank you for the opportunity. Bye.
Bye-bye.